Dana, I know you're a chief economist and you have a good macro view of the overall economy. When you see trading action like this, do you think that is connected to the Federal Reserve, the liquidity, the fact that the Fed refuses to even talking about tapering and therefore just lets the money run free?
Well, I think what we've been seeing is that asset prices in general have been rising over the last year during the pandemic period for housing, for equities. Yes, young people are at home and they're bored and they're trading. And I think all of that is certainly linked to the fact that the Fed is keeping interest rates very low. They're engaging in large-scale asset purchases, applying a lot of accommodation, and even saying that they're not looking to raise interest rates any time. But we're starting to see some cracks in the facade. You know, some of the FOMC members and even some of the Fed presidents are saying, hey, look, inflation is rising. The economy is doing well. Let's start talking about at least tapering some of the large-scale asset purchases.
In terms, Mike, of the interchange, I mean, it's so fascinating that the top 5 tickers on CNBC.com are 4 meme stocks and the 10-year yield, which one would never have imagined altogether.
Somebody cares about fundamentals, I guess.
Yeah, someone cares about fundamentals. I mean, to what extent is that a driving force at the moment of positioning? You mentioned it briefly as we were going into the close.
Right. I mean, I don't think it's really that the prime mover here. The 10-year yield actually is always pretty much in the top 10 tickers for CNBC.com, and pretty much people have no other way of finding out what the yield is at. Maybe they're looking to refinance. But I do think that look, it's part of the general kind of climate in which all this is happening. But there's a $30 billion market cap thereabouts of AMC. There's $30 billion pieces of craziness attached to all kinds of other bigger companies that have nothing real. That you can't really trace the chain of custody of those dollars back to the Federal Reserve, in my opinion. It's all just it's all just what we tell ourselves. It's part of the psychology of risk taking, but I don't think that it's about literal dollars kind of unleashed into the economy and finding their way into, you know, shares or call options of AMC.
Well, I feel like a lot of this, Dana, hinges on the inflation question. And the jury's still out, right, on whether we're going to see some sort of prolonged, sustained, potentially dangerous bump up of inflation or whether it is indeed transitory. If you look today at the 10-year break-even rates, they've come down a little bit from the recent highs. They're obviously still elevated. Where do you think we are on the inflation debate, and how will that shape policy?
Well, our thoughts of that, you know, return to 1970s style inflation, it's probably not going to happen. But nonetheless, we will see higher prices, and prices can continue to rise certainly over the next 12 to 18 months before we see the dynamics change. Some of these price increases are transitory. Indeed, things linked to the pandemic, linked to supply chains, disruptions. But also linked to suddenly services are opening back up, but there's still maybe capacity pressures. And those things are going to happen as we transition out of the pandemic era back into a normalized economy. But some other prices are probably more persistent. So prices for chips, anything that requires a chip or a battery, those prices may remain elevated. Anything linked to housing. Certainly, the lumber mills are not planning on building new lumber mills, so they're just going to ride this out and collect on the higher prices. And so some of these things are going to be persistent. But overall, our view is that, yes, the bulk of the inflationary pressures that we're seeing will be transitory. But the key question is how much and how long for the Fed to decide whether or not it's going to start raising interest rates sooner rather than later.
Shepard Smith here. Thanks for watching CNBC on YouTube.